Good morning and welcome to NASDAQ Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at NASDAQ. Joining me at MarketSite is Sylvia Jablonski. She's the Managing Director of Capital Markets and Institutional ETF Strategist over at Direxion. Thank you very much for joining us at MarketSite today. And let's talk about artificial intelligence. It's an exciting area. Where do you see growth potential? And tell us about the launch of UBOT.
Sure. So UBOT first is a 3 times daily rebalanced artificial intelligence, automation, and robotics ETF. It's a very exciting space right now because what we see is that a lot of companies are looking into ideas, design, and ways to essentially create automation within manufacturing, medical technologies, and in various different industries, including military. So what these companies are looking to do is essentially make manufacturing more efficient. So you have companies like Keyence and Fanuc that are working on smart sensors and creating robots that can essentially be programmable to do the job that a human could do within a factory. And that's important because you have places like China, hopefully America as well, that if you have growth in manufacturing, you want to be able to make these companies more efficient so that they can produce goods quicker and with enough of a population to get their demand out. You have Japan, for example, that has an aging population. So at some point, there won't be enough Japanese workers to work in the factories and produce the goods and machines and different things needed to grow their industry. So with robotics, you'll have these essentially machines and robots that can help support that as that aging population continues to grow and the birth population continues to sort of decline. On the other hand, you have also companies like Intuitive Surgical that have the Da Vinci robot. So they're looking to make surgeries, non-invasive surgeries, more efficient as well. So that's a huge space. Robotics is massively growing in the medical space. I think I recently read a statistic that they're looking for a 10% growth by 2020 in that space. And finally, NVIDIA, driverless cars, PC graphics. So you have all of these exciting companies that are going to innovate and help these different areas and sectors grow with automation and robotics. And as an investor, it's really tough to sort of pick those companies. A lot of investors might not have heard of Keyence or Fanuc or Intuitive Surgical or not know which name to pick. So having an ETF that gives you access to that space is great, and UBOT is sort of the brainchild behind that.
Well, you're also seeing high inflows and investor interest in a more traditional sector.
Yes. So I would have to say that for the last couple of weeks, anything related to oil, gas, and energy has been huge. So, past performance is not indicative of future results, and these are short-term trading vehicles. But just for the month of May, we have an ETF called Gush, and it's basically 3 times levered oil and gas-related ETFs. It's up about 40%. We have a 3 beta energy ETF, ERX. It's up about 20%, and then GasL, oil or natural gas related ETF, is up 20%. So what's happening there is that you have potentially fears in an inflationary environment coming to bay with a lot of investors. You have international tensions rising. You have the summer season coming up, the big driving season coming up, OPEC keeping supplies steady, and all of these things are really factors in that space, including, of course, crude hitting all-time highs.
All right, and to wrap up, how do investors use levered ETFs?
Sure. So there are basically 2 types of investors. There are the short-term tactical investors, and these investors have a high conviction and they're looking for a short-term trade. So they know what factors will lead them to put on a 3 beta ETF trade in any of these sectors. So for example, they have a high conviction that a market will be trending upward or downward and that volatility will be low, and they'll look to benefit in the short term for those trades. These are really for sophisticated tactical investors. On the other side, you have a buy and hold crowd. And this is the classic long-term asset allocation crowd. And what they look for is low-cost passive indexing. And we reach out to that crowd with lightly levered ETFs, so betas of 1.25 that will enhance their exposure to a particular index. So if they have an asset allocation model and they're more bullish on, say, emerging markets than S&P, they might take a 1.25 exposure in that space. Or they can simply look at it as a portfolio alpha trade. So instead of $100 in S&P 500, they can apply 1.25 beta, get cheap, tax-efficient passive indexing, and have an 80-20 allocation.
So when you say
instead.
beta for retail investors who might not be familiar with the term, so if it's something
Yes.
2 beta or 3 beta, that means 2 times.
2 times the
or
daily
3
performance
times.
of the market,
Right.
exactly. So 1.25 is a slight enhancement, and that's just because the thought behind launching that product is that over time the S&P tends to outperform. The periods of net positive compounding are higher than the short-term periods of volatility. So over time, enhancing your exposure to that index can generate positive returns and enhance your asset allocation model in the long term.
Okay, well, thank you very much, Sylvia, for joining us at
Thank you,
MarketSite.
Jill.
And thank you, investors, for joining me. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.